Thank you to BMO ETFs, a division of BMO Global Asset Management, for sponsoring today's video. What is going on, you guys? Welcome back to another video. What's going on, Dad?
Hey, Brandon, I'm looking forward to this video. It's kind of a multi-generational thing that we're looking at today and showing some of the differences between a younger guy like yourself and an older guy like me building a portfolio. So everything's good here. Looking forward to this video.
I feel like it's the perfect way to hone into our duo with the different perspectives, but exactly that. In today's video, we're going to be demonstrating exactly how easy it is to build an ETF portfolio using the ETFs of our sponsors video, which is BMO, but we're going to be doing two different scenarios. So one for, I'm a millennial, but let's just call it millennial Gen Zs, like a younger folk, and then one for the older folk, you know, the retirees, whatever you would call yourself. But I think that's kind of the idea today.
That's kind of the idea, so looking forward to it, yeah.
And I will just say, I mean, I mentioned at the top, this is we're going to demonstrate an easy way to build a portfolio, but that doesn't mean that a lot of work isn't required when strategizing and when building a sustainable portfolio and strategy. There's a lot of work that goes in beforehand to get you, in line with your investment goals. And I do think at first we need to start with the foundation. And the foundation, as our audience knows, to any good portfolio is setting the appropriate asset allocation. And the asset allocation, in very simple terminology, is essentially the breakdown of how you plan to allocate your assets or your money. And what's so cool about setting an asset allocation, Dad, is like whether you have $1,000, whether you have $100,000 or $1 million, in theory, that number can change. But that asset allocation is the structure or blueprint of ultimately how your money will be invested. And this is critical because not only will we structure it according to our goals, but it'll also help us, it'll act as a tool to keep us on track over time as our portfolio moves. We can ensure that we stay balanced.
I think that's one of the most critical things is that it'll give us that. It's like you use the term blueprint, but it's like a roadmap, right? And so if you find yourself going off of a path, you can get back on.
Absolutely. And I think what this video will demonstrate is, building a portfolio of ETFs will differ between you and I, whether that's more growth focused, more income focused, safer, more aggressive. The objectives are vastly different, and I'm sure we will have some overlap. But why don't we get into that? What are some of the key considerations that we need to think about when structuring a portfolio?
Well, I'll just chime in, Brandon. And anytime you're building a portfolio, you have to look at what the tools are that you're going to use to build it, right? So what the building blocks are. And because today we're talking specifically about exchange-traded funds, the first thing you want to consider is how many ETFs should I own to put in the portfolio? Because there are a lot of ETFs out there today, and you can end up with a big portfolio of ETFs, and you have a lot of duplication, overlap between the funds. So one thing you really have to be mindful of is don't just go like 3 or 4 ETFs that are all the same. You end up with thousands and thousands of companies. It doesn't mean you're building a diversified portfolio, right? So a key is you really have to know what your ETFs hold. And today, that's information that's really available. For example, on BMO's website, you can go in and dig really deeply to the reports, and they have to update those regularly. Questions like, are they broadly based ETFs, or some of the ones I think we're going to look at today are they're more
specific, right?
More specific, or they're more niche players. So that's a key thing there. Another thing is you want to structure, at least in my opinion, you want to structure your holdings so they're simple. Sort of like a set it and forget it type portfolios. But I know a lot of DIYers want to play more of an active role. So what we're going to show today is sort of building out with the asset allocation, and then each person can decide whether they just want to run with that or massage that according to their own goals. So I think that's kind of the key of what we're talking about today.
And I guess that's the beauty of using ETFs, and the fact that there's a massive suite of options. There's products for everybody and every different style, and hopefully this video will kind of give you some ideas on what may be suitable. And I think maybe I'll kick things off here, Dad. In setting your asset allocation, I think it's very important to do a self-assessment of where you are in life. And there's many factors that we would consider here, but I'll take someone like myself who's like, let's say in their mid-20s. I'm a little bit older than my mid-20s, but let's just say, 18 to 25 is kind of the range I'm looking at. So young, kicking off life, no longer a little teenager. You're kind of just like getting going with things. I think these are some fair characteristics, and maybe maybe I'm over-characterizing, but I think in general these are fair to say. It's likely that someone in their young 20s is probably just finishing school. Maybe they're still in school, doing post-secondary university, but certainly finishing high school, and they're possibly looking to start a career. And it's very typical that someone in their 20s would have very low expenses relative to somebody who's, in midlife or later in life. So very likely no kids yet, possibly not even a mortgage, especially if you live in Vancouver. Probably not going out buying homes unless you have some sort of money coming through the door for whatever reason. But yeah, no big liabilities like that, right? Like a mortgage. Maybe you have a car payment or some student loans. Those are manageable, but nothing major. And what I think is really important is that when you're young, time horizon wise, you have decades and decades and decades to invest. Right? When will I need this money? If this is money that I want to put away for my future or for my retirement, I literally have years and years to kind of, follow the market, to stomach the ups and downs. I don't need this capital tomorrow or next year in the midst of a crash. We can kind of stomach things. And I would say in theory, and yet this is in theory, but younger investors do tend to be willing to take on a little more risk, a little more aggressive with their portfolio, essentially striving for more growth for many of the reasons that we talked about. But I would say, to kind of cap that off, as a young person, priority number one is that we want to be growing our portfolio, compounding that year after year after year. Yeah. And that's really what's going to help us get to our goals at this stage in life.
Yeah, I think some of the key things you said there was the risk, right? Generally, a younger person wants to take on a higher level of risk than someone my age, but also you have the ability to do that because you have, you have decades ahead of you, right?
I think so. I mean, I think that summarizes it. Like I said, those are generalizations, and obviously everyone's situation is a little bit different. You're going to have younger kids who are extremely conservative, and that's the fun part about it. Everybody's different, but if I were to just kind of do a blanket statement for people in this age, I think that might be fair to say.
And that's a good point, because there isn't really, you can't make a blanket statement, but generally will capture a lot of the audience, right? So let me contrast that to someone my age. And these, again, are generally, because the first thing that comes to my mind is I would say that when you get older, either closer to or in retirement, you probably want to have, I'm going to reluctantly say the word safer retirement, our portfolio, I'll call it more conservative. And safe means different things to different people. But when I say you want to invest more conservatively, it doesn't mean that you take on no risk. Right? It just sort of means you want to focus on minimalizing that risk. And you may get to the point where you're excluding higher risk holdings. And there's even someone, let's say you're 60, you have statistically a couple of decades ahead of you. So this will evolve over time as well. But you do want to continue to have an element of growth, generally speaking, in your portfolio. Another thing that someone your age probably doesn't factor in is estate goals, right? Estate objectives. So one of the things that someone like myself or my peers would have to consider is a goal of your portfolio to preserve as much of it as you can, like live today, but preserve it so that you can pass that on to younger generations? Or is it more important for you to say, well, I've saved this money, I'm going to take as much income from it as I can and generate as much income as possible? I'm going to place less of an emphasis on saving the capital. And I mean, I worked with clients, Brandon, that said, like, perfect world, the day I die, I spend my last dollar. Like, the kids can look after themselves. So that is an important factor as well that will come into the construction. And then lastly,
I don't like that philosophy.
You don't like that philosophy?
That one doesn't resonate with me, no.
I thought it might not. But the last point I had here is that, really importantly at my age, what other sources of retirement income do you have? So if you have a really solid, guaranteed, indexed pension, you can probably afford to take a little more risk with your portfolio. But if you're relying 100% on your portfolio, that will also factor in to how you construct it.
Yeah, I think that's a really good one to finish off on, because everybody's needs for income is different. And that's one thing. I mean, even maybe it's broadly speaking, but if you just want to say, when you're younger, you're trying to grow, and then when you get older, the priority needs to be on spinning some of that growth off that you've gained over the years. And everyone's income needs are slightly different. And I think it'll be really telling when we look at our different portfolio holdings that we've selected today, how that comes into play. And I mean, I guess I can kick things off to kind of the meat and potatoes of this video. Why don't we start with the portfolio that I've designed? And like I said, this is a broad-based. Obviously, if you're in my age bracket, you can tailor this. But from an asset allocation standpoint, what I think would be suitable for somebody who's younger would be somewhere in the range of 85 to 90% in equities and 15-ish% in fixed income / cash. And that's typically how we will break down asset allocation from a high level, right? You kind of have your stock component, your equity component, and then you have your counterpart to that, which is maybe bonds or fixed income or some sort of GIC interest bearing safer investment. And it's quite clear through this breakdown that we still, as a Gen Z / millennial, are still primarily focused in stocks. And just to, I know the math. I think I said like 85, 90% and then 15%. I know that's a little, I'm giving rough numbers here, but I'm going to run for this example with an 85% equity target and a 15% fixed income target. Okay. So using the BMO suite of ETFs, the mock portfolio that I designed looks a little something like this. I want to break this exposure down within the equity component to a US fund, or one that gives me broad exposure to America. Canadian exposure would be next. And because we are younger, and for the reasons we talked about, maybe willing to take on a little more risk in our accounts, I would like to allocate some money to the international markets and as well the emerging markets. And those are kind of, you could mix those up. They are actually slightly different, as we will take a look. There's a lot of overlap within those, but that would kind of make up the equity component. Those are the building blocks, if you will, of what I think the equities should own. On the fixed income side, again, we'll just allocate 15% to a simple bond fund. That's kind of what I'm thinking today. With this mock portfolio, I'm allocating 45% to the US market using a US fund. The one that I'm using is ticker ZSP. And this is one of the most popular, in fact, I think the most popular BMO fund out there on the market. This is, of course, a fund that's going to track the performance of the S&P 500, the 500 largest companies in America. This is what I believe to be would be the core of my portfolio, and I do want it representing a large chunk. I'll talk about why in a second. Following that, roughly 25% of the account I would be allocating to the Canadian market. And this is kind of a counterpart fund. I think these do complement each other really well. You pretty much capture the North American market with an S&P 500 fund and then a Canadian fund. What I'm looking at here in particular is the fund ZCN.TO. And this is a fund that simply tracks the TSX. So the TSX Toronto Stock Market Index, some of the largest companies that you're going to know and love here in the Canadian market are big banks, energy companies, telecoms, you name it. Between these two funds, we're going to have an array of the largest North American equities under our portfolio. And I think that's a great starting point. And just to touch on that briefly, why I allocate 25% only to Canada, it's not because I hate Canada. I know a lot of Canadians love to invest in Canada, but up on the screen, I'll just share with you some fascinating stats. We're looking at the past performance of the two funds that we talked about, so the S&P 500 fund and then ZCN. And what we noticed, just looking in, let's say, over the past 5 years, so we can look at a more relative period, not since inception, because funds do start at different times, but just over the past 5 years, the American market, the S&P has outperformed the TSX, and historically, the US market tends to be the better performer. Now, obviously, there's going to be periods of times where that's not the case and it's, goes the other way. And of course, this is past performance, so this doesn't mean this is what we can expect. But just in general, the American market is a larger market. It's more diverse. You think of the biggest companies in the world, Dad. They're coming out of America, more so than Canada, just to be completely fair. And that's why I do think it should be a bigger part of the core of my portfolio. That's kind of why I've set that as such. Moving on with that core aspect aside, I'd like to allocate about 7.5% to an international ETF. We've already ticked off North America. We're very diversified there with those two funds alone. But then we can look internationally, look abroad with a fund such as ZEA.TO. And this is the BMO MSCI EFI or EAFE index. In fact, this is essentially a fund that will give us exposure to a ton of global equities, excluding the US in particular. And this is a fund that trades at such an affordable MER, considering it's a global fund. You're paying 0.22%. This is, in my opinion, an extremely fair fee to pay to go get this global exposure. The two funds prior are going to be so dirt cheap. I mean, it's just marginal how cheap these ETFs are, which is why low-cost index funds are such a great way to invest. But if you take a look up on the screen, you'll see some of the companies, and feel free to pause this or just take a look. You're going to notice some names. So names out of Europe, names out of Asia, such as Japan, like Toyota Motors. One thing about this fund that our viewers, will recognize, there's not much Chinese exposure, and to each their own, right? Like I said, if you're building your own portfolio, this is what you were mentioning, Dad, where there's so many resources online where you can go look and understand what you own. But there are a couple key components missing, in my opinion, to a completely well-rounded equity portfolio. Hence why with the remaining 7.5% of the equity exposure, I would look to an emerging markets fund such as ZEM.to. And this is the MSCI Emerging Markets. When we see EM, that stands for Emerging Markets. And I really think this caps things off. You got a very similar MER, slightly higher at 0.28%, but again, so affordable at the end of the day compared to, let's say, mutual funds. And what I like about these two funds complementing each other is they do have exposure to some rapidly growing markets such as China, Taiwan, India, just for example. So up on the screen, you'll see some of the, the big Asian holdings, and, India is just a nation that's just rapidly emerging and growing in population and innovation. So they do kind of complement each other in that aspect. And to me, though, these four funds for a young investor can really just get your basis, lay it out for all sorts of different investments across the globe. And I'll just quickly cap off fixed income. I don't have too much to add here, but with the 15% that I've allocated to fixed income, I always like leaning with ZAG.to, which is the BMO Aggregate Bond Fund. It's essentially just a basket of investment grade bonds. You're going to have corporate, federal, bonds. You're going to have corporate, federal, provincial, just a big mishmash of all sorts of bonds. You can just keep it really simple and let them do all the heavy lifting with the bond selections, but they're all different types of terms. And this one, again, is extremely cheap as well, 0.09%. It's yielding 3.57%, which is pretty solid for a bond fund, at least what I'm used to from over the past few years of being an investor. Starting to creep up, obviously, as rates have come up. But that, in my opinion, would be kind of what I'd like to structure as our mock portfolio for today's exercise. And one thing I'll say is, maybe some younger investors, like you're 18, you don't really want to have the fixed income. That's understandable. And I think I say fixed income, cash, that can vary, right? You can kind of wiggle back and forth, and maybe it's more so keeping 10% cash in the portfolio. It's preferential, but that would be my breakdown. I'm actually really excited to hear yours, Dad.
Well, yeah. Interestingly, I think, Brandon, first of all, there's going to be a couple of overlaps in the funds that we're using, which makes sense to me because we're not trying to reinvent the wheel here. There's that core of your portfolio that we believe you should have, but then a little bit differences, for example, in the percentages. But I'll just sort of get into my thoughts on someone who's, say, for example, a little bit older, I don't know, maybe 45, 50 plus, let's call it, right? Close to or in retirement. And perhaps surprisingly, this is not a very, very conservative portfolio. In fact, for the model I'm going to roll out today, I'm going with a 70-30 split. So 70% in equities and 30% in fixed income. For a lot of people, that's fair, but these could be adjusted to 60-40 or 50-50 or whatever you feel comfortable with, right? The difference here for some of those specialty, like for example, you had the emerging markets, etc. I'm not going into that space. I'm going to, my international exposure is going to be more in the conservative space. So let's talk about those for a moment. But like you, I have weighed more heavily in favor of the U.S. market when it comes to the overall allocation over Canada. I'm allocating 25% directly to the U.S. market as a core of there, and 15% to Canada for the same reasons you articulated. First of all, most of the global leaders come from there. It's a huge market compared to Canada. So it just makes sense to me that you would do that. I'm also going to put 15% into the international markets. So more specifically about that in just a moment. I have allocated 5% of the portfolio for I'm calling it a specialty fund or a focused fund. And this would be sort of more something that an investor might change around a little bit. I'm going to use I'll show you in just a moment here what I'm going to use for today. But it can be shifted around. 10% of the fund going into a higher yield fund, so a fund with a covered call overlay to generate the extra yield, which someone like myself might need, and 30%, a higher number, to fixed income. Unlike you, I'm going to split that between two different funds that I think complement each other. So like you say, regardless of what numbers you're looking at, because not every 60-year-old has the same amount of money, but you should be able to especially looking in BMO's suite of ETF products, there'd be no problem choosing funds to fit the needs here. So I'm going to look to strike a balance with a strong core portfolio and then some flexibility for those investors who would like to manage a little bit more themselves as well. So I'm going to look at 7 ETFs overall, which I think complement each other. So a little bit more than you. Starting off with, I want to say 15% of your portfolio should be ZCN. So you also picked ZCN as your exposure to the Toronto Stock Exchange. And I'll just throw a graphic up on the screen here. You can see, obviously, very heavily weighted in the financials and in energy. That's where the Canadian market is for the most part. You can see the names of the company that you would own on here. The fund is considered to be a medium risk fund, right? With like your fund's a very low management expense ratios, almost, it's 0.06.
Negligible. Yeah, you could
so
argue.
you could argue it doesn't really matter, but that is the cost to own this type of a fund, 0.06. So in this fund, you get an exposure to the Canadian market, which just represents the Canadian market. It actually tracks the S&P or the S&P TSX, a capped composite index. So you can see on the screen what you get here. Now, to complement this, I picked ZUE, which is another BMO fund. Now, this is a sister fund to ZSP, which is a non-hedged version. This is hedged. Now, this is something that you can choose to hedge your dollars, not hedge your dollars. I'm of the opinion that over time, unless you're actively watching the currency, the fluctuation and changing it, it's going to net out for the most part. But this is the hedged dollars, the hedge fund. It's the S&P 500 like you had. And again, you can see on here where what you're owning. Large companies, if you look down sort of the left side here, you're going to recognize pretty much all of these companies. The portfolio allocation, the construction though, is different, much more tech weighted here, healthcare weighted, which is, I think it complements the Canadian fund as well. Again, medium risk and a 0.09% management fee on this. There is a small fee that you pay for that hedging capacity there. Now for my global exposure here, I've picked STPL, which is the BMO Global Consumer Staples Index. And this tracks the Russell Developed Large Cap Consumer Staples Capped Index. And again, this is hedged to the Canadian dollar as well. Now, this I find to be serving a lot of purposes. First of all, when we look at sort of the makeup of the portfolio, it's up just over half in the US, but then we see, again, broad exposure to the rest of the world. The sector allocation is all stuff that you're going to need, whether we're in a recessionary time, whether you're not in a recessionary time. So when we look at the names, Procter & Gamble, Nestle, PepsiCo, Coca-Cola, etc., these are all products that people use around the world pretty much all the time, whether there is a recession, whether the markets are good or not. And that's one of the things I'm looking for as a more mature investor, is that stability. The fund is rated low to medium risk, so a little bit lower risk. And if we look at this, just some recent numbers, 2022, the fund dropped 0.3%. Now, remember what the markets did last year in general. It was a bad year in 2022 for the equity markets. So this brings a lot of stability to the portfolio. So when I marry this with the two funds I just talked about, this provides that ballast in there, an MER of 0.4%. So I think that's a reasonable cost for this global exposure. The specialty fund that I want to allocate 5% to. This can be fluid if you work at, let's say for example, you want to get into, exposure to a certain sector, a certain industry that isn't covered to the extent you'd want in the other funds. You can go there. But for the example I'm using today, I'm picking a ZQQ, which tracks the NASDAQ 100, and this is hedged to the Canadian dollar. So it's the BMO NASDAQ 100 equity index. As I talked about earlier, it's important not to get a whole bunch of overlapping and a whole bunch of duplication. And this, there is, a considerable amount of exactly that here. You look at the names. This reminds you probably a lot of the S&P 500. This is very specifically to the information sector. We see 50% IT, 15% communication services, and then 14.5% to consumer discretionary. So there is that overlap, but I would use this for an investor who wants to just boost up what the S&P 500 would give. And as we know, that changes from time to time. Right now, it's very heavily weighted in this space, but that will change, whereas this will stay specific to the technology sector, to the communication. So it's more of a complement to the other funds. Medium to high risk. So this is the only time I'm taking 5%, maybe go into that high percent or higher volatility portfolio if you want to be tactical. If you had no interest in this, I would just bump up the weighting of the S&P 500 and not worry about this at all.
Right.
A specialty fund. Covered call utilities, the ZWU, I'm going to put 10% into the BMO covered call utilities. This is kind of me, the best of both worlds, where you have a sector, a space that I like. You have the consistency of the utility sector, which typically, isn't exciting. You're not going to get, 100% returns in a year like you will in the tech space, but it's going to be predictable. This has a good allocation between Canada, between the United States, and you can see some of the names on here, some of the names that, as utility investors we know and love here in Canada. A little bit higher management fee. The MER is 0.71 and the TER, the trading expense ratio, is 0.95. And that comes mostly because there is a covered call overlay to generate higher yield on this. So this is one of those funds where if you're looking to increase the yield that you're spending on a regular basis, you are going to pay for that, for the underlying structure. And when I look at the covered call overlays that are available today compared to doing it yourself, well, first of all, most people probably couldn't. You certainly don't want to. It's a lot of work. So it's well worth that extra management fee, in my opinion. 15% of the portfolio. So I'm going to move on now to fixed income. So 15% of the portfolio, I've picked the same fund that you have, Brandon, ZAG, which is the BMO Aggregate Bond Index. And that is 1,400 bonds in Canada, something that no person could ever manage on their own. So we rely on professionals to do this on our behalf. 35.5% federal bonds. You've got 35% provincial bonds. A little bit of exposure to corporates and debentures, etc. So this is sort of low risk, boring, but I feel for an older investor it does play a very important role in providing ballast to the portfolio. And the last 15% is ZQB, which is the BMO High Quality Corporate Bond Index. And this this tracks the FTSE Canada 1 to 10 year A+ corporate bond index. So it is more focused on, it's focused on the corporate side of things. So an elevated level of risk, in theory at least, but also more return that would be expected as a trade-off for that as well. Because it's Canada, it's more heavily focused in the financials, utilities as well. So those are the funds that I think would form the good base of a portfolio for a lot of investors who want to go the route of ETFs.
I really like that. And hey, if you guys have been enjoying the video and like the two different examples that we've illustrated, please do drop a thumbs up and let us know what you think down below. But I think even as you're explaining that, Dad, we can compare and contrast. They're two very different portfolios. And I would say I even kind of lean more on the simple kind of passive index style. Is it fair to say you've kind of I don't know if core and explore is the right way to look at it, but you've kind of got the core and then you've got a couple more unique ones that I think you've baked into this outline. And I really like that. And you obviously targeted them and catered them more to the needs. Like, for example, I wouldn't be out buying a utility ETF, especially with a covered call strategy baked in, but that may be a perfect example for somebody that's a bit older. And that's a great contrast there, even just with that example.
Well, as I said earlier, we kind of have a similar thought on what the core of the portfolio should be. But once you go outside of that nucleus, then we go in different directions, and that's what you'd expect. And I just want to reiterate, I had used 70-30 as an example. But if you're an investor who wants to simplify things, maybe you take out that specialty fund. That's quite possible. You just adjust those. And the other controversial one for me would be the NASDAQ, because it is a higher risk portfolio. Heck, I worked with investors who were in their 60s and 70s and even 80s who said, I want to take a portion of my money and I want to have that opportunity for growth there. So
risk it for the biscuit.
Not one size fits all. Risk it for the biscuit.
Hey, exactly. And I think I like how you kind of capped that. You had a target of 5%, and that's different from a younger investor who may put significantly more. So you did make a clear point of emphasizing that. And I think just in general, to cap this video off, what would we expect from the two different portfolios? Obviously, mine with the 85-90% equity weighting, we would expect to see more volatility. I have the international exposure, I have the emerging markets exposure, significantly less bonds than you. We would expect a portfolio like this to be more volatile relative to one like yours. And I think yours, especially for example, with those covered call ETFs, would generate a lot more income than a portfolio than mine would. And of course, the 30% weighting, give or take, to fixed income as well.
That's key. And I've always said at the outset of an investing journey, you have to sort of do an honest deep dive into who you are and understand the path that you're going on, because there can be very windy paths or in a chart like this, or smoother paths. And the older people, when you have maybe you don't have an income anymore because you've retired and you're relying on this, it gets scary out there when the markets take a big hit. Now, even if you feel this growth over the next decade or two, these growth companies are going to outperform, that's great. But when we see a crash or a correction like we saw last year, a lot of people just get scared out of the markets, and that creates even more problems, right?
That's the worst thing. Yeah, that's what you want to avoid. And I think that brings us full circle. It brings us back. Like, these are samples that are based off of the different objectives that we set and our particular goals that we outlined in the very beginning. And I will just remind you that it is important to remember there is maintenance required over time to rebalance back to this asset mix that we're setting, right? So it's like step one, do the self-assessment, understand the goals, what your time horizon is, everything. Then you build this plan, this outline or blueprint. Once you get your funds in place, for example, if you looked at the funds we use today, I mean, they'll all be linked down below. You do still have to do the regular upkeep to make sure you're balanced within the right geographies and on target with your different asset scheme. But other than that, this index strategy portfolio is really such a passive, I would say for the most part, hands-off, not as active strategy that works well for so many people as investors. And that's why I guess we're happy to highlight this. I will just say one thing too that pops to mind. I mean, if you're not even interested in taking it this far and, essentially DIYing your own breakdowns, we've done videos in the past with BMO on their all-in-one ETF solutions, like the asset allocation solutions. You could take it one step easier and essentially have a predetermined asset allocation for you. There's so many layers to the options out there. And to me, Dad, that's the fun part about DIY investing is you could take it so many different ways. And I want to thank our sponsor, BMO. They have just the most comprehensive suite of ETFs to choose from. There's so many low-cost choices. It's more so about finding what's going to work for you. And of course, you can learn more all about that and more at their website, which is bmoetfs.com. Good.
Well, hey, Brad, I think this is a good exercise. I enjoyed going through this with you and seeing the differences that I kind of would have expected between the way you would manage your money and me, and probably a lot of our viewers. And, we do have quite a range of ages that and life circumstances that watch us. So hopefully this will add some value to everybody watching the video.
I was thinking about just saying 100% into Bitcoin, and then I just, I thought back to all of the things you've taught me over the years, and this is what we've landed on. And
you're gonna cap that at 90%, eh?
Just 90%, yeah. But it was super cool to hear yours as well. And thank you to everybody who's made it through the video. We'd love to hear your thoughts down in the comment section below. So let us know what you think of these. What are your favorite ETFs? What is the asset allocation you guys lean for? Leave a comment down below. Drop a thumbs up. But we thank you for watching. We hope you enjoyed. And we'll see you in the next video.